Hello again, everyone. I hope you had a great coffee break. They say that AI is going to replace all of us in the next couple of decades. But looking at how technology has been working in the last session, I don't think we have anything to worry about. So, well, moving on, we have another very interesting panel for you. It's about sustainability ratings and how investors use ESG ratings and benchmarks. On stage, we have Matthew Tippet from JLL. He's the moderator of this panel, and he's joined by Jasmine Mehta from MSCI, Roxana Isaiu from GRESB, and Peter Van Den Tol from MN. Matthew, over to you.
So I'm going to aim to get as many questions from you guys as possible, so don't expect thousands of pre-prepared questions from me. So get your brains back in gear. Imagine you're in the daylight, the air is fresh, there's no annoying noises, you're feeling good. Everything's working just great. So again, we had it a little bit earlier, but just to see who's in the room, thank you for staying with us for the 3:10 slot, the best slot, of course, of the day. We're going to have, from left to right, short introductions from each of the players here. We're looking at ratings. I don't imagine anybody here thinks that they're entirely perfect, nor that they're entirely useless. We're going to have a look at the value of them. And we're going to be first hearing from Jasmine from MSCI, second from Roxana of GRESB, and third from Peter from MN as an investor. But just before then, I want to see who you guys are. So hands up for specifically GRESB or MSCI if you're working for a company that is assessed by either of those two things. Hands up. Plenty. Hands up if you're consultants helping those people. A fair few. And just to see how many investors we still have in the room who actually uses GRESB from the sort of the investor end. We've still got
we don't have to introduce ourselves.
4. Yeah, exactly. So there's a good 4 still there. So thank you for sticking with us. So the broad framework of what we're going to try and get at here, everything has strengths and everything has weaknesses. Some are more known and some are less known. So imagine in your mind, you don't need a PowerPoint presentation to see this. You have a quadrant in front of you. And in the top right corner, you have the most known strengths. That's probably what you're going to hear from what people speak about in their first 3 to 5 minutes. And then we're going to ask some questions about the lesser known strengths. So we've got our dispelling myths part. But then in the spirit of improvement, we'll also have some thoughts about more known weaknesses and what both those being assessed, those doing the assessment and those using assessments, how they can perhaps overcome some of those weaknesses. And let's see if there's any lesser known weaknesses that we can also identify and tackle. So that'll be sort of the broad framework once it comes to questions. But before then, just 3 to 5 minutes from left to right. Jasmine, please first.
Sure. So thank you for having MSCI here. So I'm Jasmine Mehta, and I'm really responsible for engaging with issuers that we rate at MSCI at the ESG level, and engaging with them and sort of helping them better understand how we assess companies and the broader ESG dynamics and the most relevant material risks and opportunities for companies across all sectors. Of course, we've seen a massive uptick in engagement and response rate from real estate companies, really just justifying the reason why we all are sitting here today. So in all, we're at MSCI a team of 325 dedicated to ESG. We have over 185 accounting analysts with on-the-ground local expertise in just about every major market they cover. That further chimes into the research and assessment that the analysts comment on. We have over 1,200 clients, mostly institutional investors that really use the research, ratings, data, solutions in a variety of ways. I'm sure Peter can touch on that, but I think I'll just probably put in a couple of points at the end. We see a massive uptick or a dramatic rise in interest for ESG, not just in real estate, but across all sectors. We see the UNPRI, which is the United Nations Principles for Responsible Investment, their signatories base increasing to 1,900 now in just a decade, representing over $81.7 trillion. And that, again, really testifies the growth in ESG investment. But I think it's more important to understand how is it relevant to investors? Why is it that they care about ESG? And I'd just like to draw 4 main reasons. One is there is now understanding of greater potential financial benefit. So ESG strategies have been backtested over the last so many years to understand that ESG data provides or improvises on risk-adjusted returns in portfolio analysis. The other reason is the fact that there's now a greater proliferation of data that underlies ESG risk exposure that companies face. And that's really leveraging alternate data sets to company disclosures. Number 3 is we see investors are becoming less tolerant of corporate ESG incidents. The latest one with Nissan, there was Volkswagen, Equifax, and so many more. And then finally, we see investors actually demonstrating their willingness to act in this regard. From 2014 till date, we've seen a significant increase in now to $180 billion allocated to ESG investment strategies through MSCI ESG indexes, both on the equity and the fixed income front. So really, let's take a step back to better understand, where do investors really come from? What is it that's driving them in terms of their objectives to look at ESG? So one that we see pretty often is, or the one that has sort of been predominantly, in the space has been screenings or exclusionary or negative, impact-oriented investment strategies where investors really screen out companies with negative externalities. But now we see a massive uptick in increase in investments or interest rather, for impact-oriented, addressing social and environmental concerns through impact investing, really touching upon the UN SDGs. And thirdly, by far the largest use case that we've seen is for improving financials. So that really is the ESG integration strategy we see, where investors are looking to minimize risk exposure and make their portfolio a lot more resilient, but also maximize or enhance on profits or returns. And really to that point, we provide MSCI ESG ratings, which is a AAA to CCC scale company assessment. And I think it's kind of important that I clarify at this point that we don't do a fund level or a portfolio level analysis, but it's more on the company level, where we run a AAA to CCC scale on a rating basis. But what it really looks at is a company's exposure to industry-specific risks and the ability to manage those risks relative to peers. So it's a sort of a peer set analysis. And really this is used by, for the purpose of identifying leaders and laggards and does not sort of aid business type exclusion. And then really what goes into the analysis and assessment at the first layer is a deep governance assessment. That is a pillar that is equally weighted for all companies across all segments, as we believe governance is a common denominator, the board, the management structure. And that's really where we do the governance assessments around, director level data, governance events, controversies, pay governance, around accounting, ownership, and board control. And then we kind of deep dive into industry-specific risks. So for real estate, that will be really around health and safety, that will be around human capital development. But we also look at opportunities in green building that companies could leverage on. And then, finally, we sort of run this assessment for just around 7,000 companies globally, but that includes 13,000 when you include subsidiaries. So yeah, I think I'd like to just probably stop here and wait for some more questions on some critical ESG assessment here.
Roxana.
Well, Jasmine made my life easy because you already covered some of the key elements why investors care about this, so I won't cover those. I'll give a very brief introduction to GRESB since most of you know what it is. I guess the reason why, well, it's also different scale. 360-something analysts with ESG. We've got 26 people in total. But we provide ESG ratings for both listed and private entities. So they're not at company level, they're for individual fund level or real estate portfolio. So in the case of listed companies, that's definitely the company. And that's based on self-reported data from the entity itself. It's done on an annual basis. It's done on industry-specific indicators that are very much aligned with or informed by what the leaders in the industry are doing, aligned with what the big majority of the companies are doing, and trying to encourage or bring upwards the companies that are learning how to incorporate ESG, are learning what ESG really means truly, and are learning how to address the requirements from the investor community. So I would say I spent the majority of my time identifying what those material ESG elements are and trying to reflect them with a lot of industry engagement, a lot of help from you, really, both the reporters, the company that provide the data, as well as the investor community, on what the sweet point is between what's absolutely material, what has a direct impact and relevance on the final output. And I know we're going to talk about some of the misconceptions and the pitfalls of, I think, ratings in general, and what a number can really tell you when it's based on hundreds of variables that are very different, stemming from environmental, social, and governance points. But in the end, ESG ratings are meant to provide a tool for engagement, and we see that this is how a lot of investors use our benchmark. They're meant to provide a comparability element, a comparability issue. And here I'm not referring to that one number, again, the final performance number, but I'm referring to the entire analysis that comes from this pretty extensive reporting exercise and engagement exercise. So we see that over the last 10 years, since the duration of which we've been doing this analysis and we've been collecting data, we see that the level of understanding and the level of complexity of the data that can be reported has increased dramatically. 10 years ago, I think we were asking questions, binary questions, yes, no. Do you collect any data? In the sense of, if you have a portfolio of 1,000 buildings, do you have data for 5 of them? The answer would be yes, and now yes or no. And now we're at the point where we ask for scope 3 emissions, and we can do very detailed analysis on granular performance elements from the buildings themselves.
How do you use ratings?
Yes, how do we use ratings? First, I'll introduce myself a little bit. I'm Peter van der Tol. I work at MN, one of the bigger pension funds operators in Holland. We work for the production industry. Of course, that's also an ESG or an E-intensive industry. So for us, it's a topic very high on the agenda to include as much as possible the ESG assessments from different rating agencies within our investment process. Last couple of years, I think, I don't know exactly how many years already, but at least 10 years, we fully integrate the ESG information and risk assessments within our investment processes. When I talk about real estate specific, we use both GRESB and MSCI for a long time already within our assessment model of the relative attractiveness of the companies on the listed side. We also use the GRESB on the non-listed and on the direct side. Of course, we also manage a really big direct portfolio situated in the Netherlands, and we started to participate at the GRESB this year, and it's something that will evolve and will strengthen in the next couple of years. But when I talk about the listed side, we look at the GRESB score and we look at the MSCI ratings within our relative attractiveness model, alongside with the more quantitative elements, the financial elements, more long-term trends. And if I talk about ESG, because a lot of the ratings, they resolve in a number or in a rating letter, A, B, or a triple B, or double B, or a figure At GRESB, it's 69 or it's 90. For us, it's not necessarily about the number, but about the qualitative aspect of the rating. And for us, one of the things that's really important is the way that we as an investor can have insights in the construct of the rating. Because we see the rating as an outcome, but there's a lot of information lying behind these kind of ratings. And for us, it's actually especially about what's lying behind the outcome. So for us, that's important. And what Roxana also said, we don't use it as an exclusion criteria or an inclusion criteria, or if you have a high score that you get a higher overweight within our portfolio, but we use it primarily as an engagement tool. But to give a little bit more insight in the way that we determine the relative attractiveness, we look at all the different quantitative and qualitative aspects of a company, and especially on the underlying real estate within the portfolio. And we, depending on the relative score on that specific aspect compared to their peers, and the peers is not sector specific in this case, but it's the total benchmark that we invest in. Depending on how much better you score in this aspect compared to your peers, you get higher points. On average, for instance, a company gets 15 points within our rating model. And ESG can account if you're, for instance, a GRESB 5-star, you get 1.5 points. And if you have 0, or if you don't participate, you get 0 points. It doesn't necessarily mean that you are underweight or overweight, but it's a starting point for us to determine the amount of over or underweight. That's it in short, yeah.
So in the back of your minds, companies who are being assessed for GRESB and MSCI, think about the things that you think, I'm really glad that investors use the ratings in that way, and think about the ways like, oh, I wish that wasn't quite interpreted or used in that way. So have those things in the back of your mind, and then bring them to the front of your mind, so that they're becoming questions that are coming to your heads. So I'm going to ask you, I think you've already said what some of the key strengths are. What do you think in sort of the dispelling the myths kind of things? What are some of the lesser known strengths of your own systems that you'd like to just dispel any myths, people misusing or misunderstanding the method or the purpose or the use of the ratings? Jasmine, do you want to kick off with that? Lesser known strengths.
I think I'll call it more of debunking the myth here, so to say. And I think in my interaction with companies, a lot of times, they ask me whether increased disclosures would drive to improvisation of ratings. And my answer to them is it's not necessarily the case. I think for that, you really need to deconstruct the rating to understand what's really sort of powers into a rating. And to what point can corporate disclosure influence that? And if you look at the MSCI ESG rating, and if that's deconstructed, it's really 1/3 of the rating that is derived on the data basis corporate disclosure, and the others are derived, the other 2/3 is really derived from alternate data sources that measure risk exposure, that look into controversies. Having said that, we don't want to dissuade companies from disclosure. I think it's more about identifying the material risks and then sort of strategically reporting on programs, initiatives, targets that exemplify performance, sort of build up track record to mitigate or manage those relevant risks. So that's really from my end in terms of corporate disclosure.
I would address the issue of resources that have to be allocated to not necessarily to the reporting process per se, although that's a part of the person's responsible job, but to ESG and sustainability as a whole. I would say for sure when a company or a fund or an investment vehicle or whomever starts mapping everything that they do internally, that's going to take the time from somebody. And I think one of the lessons learned from a lot of the companies we've seen and we've evaluated is that you can't really expect year-on-year improvements unless there's assigned responsibility to someone. Be that part-time or full-time, you can't expect that the company is going to do better, you're going to see better results reflected in your scores or in general if there's no one that you can pull in at the end of the year in an annual review and ask, how did you do here? What's the target for next year here? And track progress against that. But that doesn't mean you have to allocate a huge amount of resources to it. There are many opportunities for improvement with very few resources. I've talked to a lot of companies that said, at the beginning, I was the only one, or me and one other person within the company were the only ones that even knew what this means. We had to get the management buy-in in order to get actual money to actually implement new things. So you have to start simple. You have to start with things that don't cost a lot or don't cost anything, but have a positive impact on revenues. And you have to express that in dollar value. You can't say, we did this, but then nothing really happened. You have to put a price tag on it. And I've seen a lot of successful employee engagement programs and talent engagement programs where it's just about awareness and increasing awareness and getting the buy-in of employees. And we heard this morning an example of that as well. And then it's just a matter of trying to quantify that into something that can appeal to the top management. Once you get that, it becomes easier and easier to really integrate ESG into the whole strategy so that it becomes part of the whole strategy. And then you don't need a department. Actually, I don't think I've seen or I've heard of any company out there that has a full ESG department or a full sustainability department. It's typically a one-man show or a 2-3-man show that do it.
So begin to open it out. I've got a few things to come back to if there's tumbleweed and stunned silence amongst the audience. But why don't we see if there's any questions from initially, I know we've still got a couple of investors, but from those companies that are being assessed, what's the single biggest thing you'd like the rating systems to change that would make things better for you? So anybody got anything of those from any of the companies out there? Don't be shy. Putting you too much on the spot? Come on, Louise. One lady at the back.
Discouraging.
Yeah. So it would make it much more easier for us to do assessment accept some sector specific.
Yeah. Well, I can address that to begin with, and I don't know if you accept input from other people in the audience,
yes.
From investors in the audience. Our challenge there is GRESB at its core and by definition is an investor-led initiative. It's meant to give investors a consistent and simple way of assessing all their investments. We've evaluated the possibility of doing more sector-specific or creating sector-specific indicators and defining materiality for different sectors. You go down the rabbit hole very fast, very deep. The moment you enter local legislation and try to interpret local regulations for each property type or even for specific property types, the risk of introducing more bias and more inconsistency into the benchmark becomes even higher. I know and I recognize you can't have a perfect fit with one set of indicators for absolutely every property type in the world and for every country in the world. That's clear. But let's just say we haven't been able to figure out a better solution that would replace the existing solution. And I don't know if, Peter.
Maybe I can also answer it from an investor perspective. I fully understand the question and the remark that you make. That's also why in the beginning I said it's not, for us as an investor, it's not a quantitative aspect, but a qualitative aspect. And especially if you have ESG ratings that offers you insight in the performance sector-specific and country-specific, that it gives you enough starting points for a discussion and engagement with companies such as yours. And then you as a company, you have the opportunity to explain, because for instance, if you underscore on a specific topic relative to the total benchmark, that's one. But then we also look at how you score relative to your peers. And if it's a sector-specific aspect that is not valued, maybe in your eyes, sufficiently by the rating agency or the rating company, then that's something that we can talk about during our engagement sessions.
Any other perspectives from any other investors so far, immediately on that? If you see a company who might argue, the rating misses out on our special circumstance. Any other investor comments from the floor? Give you a chance.
I have to say it's really refreshing, Peter, to hear you talk about your application of GRESB in the way that you, the other rating systems in the way that you do, because in my experience that's really rare. And in most cases people are using it as a really, or them, as a really binary basis for not necessarily excluding or including stuff, but there's an awareness of the limitations of a relative benchmark, but still a focus on the relative benchmark to drive their decision making. So it's nice, but you sometimes find that an institution, you'll get a different perspective on how they apply the benchmarks and the indices, depending on who you speak to in that institution as well.
Yeah. It's also within our company a point of discussion quite often. Yeah. And I have to say my background is more technical from the architecture side, so that also offers me more background information on how to interpret scores on different segments. Yeah.
Louise?
My point was going to be kind of related to John's. Do you kind of acknowledge or potentially... Do you acknowledge or consider that there is a risk that by presenting a number and the performance of companies in terms of their sustainability as a number, that there are the vast majority of investors out there who don't have people like Peter, who don't necessarily have ESG, who are very mainstream investors, who will not necessarily go into that detail about the issues with residential sectors and different kind of sectors and how that's going to make them underperform in terms of GRESB scores, and that it has the potential for driving sort of suboptimal behaviours in those businesses in order to try to get those scores up, but also it's not actually giving the investors the information they really need. I mean, at what point would you start doing some back testing to see if actually the scores that you're giving that they're getting, that's actually being valuable for their portfolio management and for their risk management within those portfolios? Because I can perceive a point at which actually just using GRESB in a relatively simplistic way, it doesn't necessarily help. And it certainly doesn't really help in terms of the wider issues that we've been talking about today in terms of climate change.
No, I agree that, and we're the first ones to say that indeed that score or the GRESB performance shouldn't be interpreted just through the perspective of that one number. And that's why we're offering multiple numbers that go really at the top of the page with that are meant to express different elements of performance. GRESB will be 10 years old next year, and that actually gives us a good point to start doing some of this backtesting analysis. I think what we've noticed is that the benchmark itself, the indicators, the quality of information and everything that goes in it has evolved quite a lot at first. It has stabilized over the last 3 to 4 years, I would say, particularly. So now we are starting to have sufficient information that can be used for this type of analysis. So absolutely, we'll start doing some of that.
At the risk of being slightly
Go on.
And I would say one could say that there would be a vested interest if you were doing that analysis to say yes, it works.
No, we would love to be able to prove that. Yeah.
Will you kind of make the data available and open to other kind of independent agencies or organisations to be able to do that and do that analysis at a proper level, so that it becomes quite robust and the industry can feel that they can really rely on it?
I can't confirm nor deny that now. I think we'll have to evaluate, obviously. But we're definitely at the point where we can start looking into that, and we've started doing this analysis internally, and we've started creating or providing more insights into market trends, especially on alignment with the SDGs or compliance with TCFDs. We're working with we have a separate project that's it's called CREM, through which we're trying to create an analysis that's or a platform, a tool for managers to do scenario analysis using the science-based targets. So the data is put to good use, but there's a lot to be done in terms of the data quality itself as well. Yeah. Oh, I love to answer this question.
Yeah, no, for sure. It does sound, pretty convincing to run that through. Of course, we haven't done that justice yet, but I think certainly something to be done about. Yeah.
I'll throw another question out there. There's a few more coming. Go ahead.
Thank you. Jane Shaw, Octopus Healthcare. I have a question. Jasmine, you mentioned earlier about it's 1/3 data, 2/3 controversy and risk. When you think about the context of climate change and why we're here and sustainability and the measures that we've got, how much do you think investment people are looking at this just to protect the value of their own investment versus how much of this is actually about, are we doing the right thing and is this better for the wider measure of environment and climate?
Oh, that's a good question. So I think it drives back to investor objectives in terms of better sort of understanding that aspect. With respect to climate change, I think every investor we speak to is more concerned about climate change and the impact that has to their own portfolio of securities, which would of course include real estate companies. But in terms of our own assessment, we sort of revise our models to sort of get in the angle of climate change vulnerability to real estate companies and their portfolios. But yeah, I mean, that's something that we're looking at. But I think investors really want to understand the financial concerns around climate change vulnerability or the impact of that to real estate portfolios. And it's pretty clear from the sort of client set and the wider interactions that we have that is financials are sort of driving concerns with investors.
So if some investors, not all, but if some investors are using ratings too simplistically, if that's the case, first of all, do some people think that is the case? Anybody got any cases of an investor doing so?
Yeah, I think just to elaborate really on what was talked about GRESB earlier, there's investors who are favouring, and just how strongly is a point I can't really comment on, I suppose, but saying we're going to favour 5 or 4-star GRESB ratings, which is great and that's sensible. But then because that's just relative to the quintile performance against the whole GRESB universe, that could penalise certain sectors who are never going to be in that top quintile, but are nonetheless, from a materiality perspective, doing what they need to do in a really positive way to tackle some of the major issues like climate change. So I think there is a risk, just to really go over ground that's already been gone over, that it is driving potentially the wrong sort of behaviours and it's oversimplifying it. Not everyone has Peter's level of understanding or resource to be able to do that detailed analysis, and they're just going to say, well, if it's not 4 stars or above, we're,
So I've got a little suggestion I'll make in a moment, but have any companies had any instances where they've said to the investor, can you be smarter about the way that you're doing this? Any examples of challenging them if they were saying, don't ignore me because I'm a 2-star, I happen to be distribution sheds? Any examples of that? Okay, my suggestion is, what about variable weightings? What about investors actually not just taking a default weighting? And where's Hans? Is he still here? Maybe not. Wanting to say what matters to us. We're not just going to say that performance measures should be 25% of score, they should be 30, and within that, I'm going to focus on this. So what about that as an idea that some investors might be interested in? So not just taking the standard weighting between sections. It's an encouragement to dive under the bonnet of a rating a little bit. Any of the of all the investors left now? Got any left?
I can respond to that if nobody picks up the. I totally agree. But that's also why I think it's really important for the ESG rating companies and agencies to provide more insight in the way that scores are constructed, and actually. In this case, GRESB offers a bit more insight in the underlying questions and the underlying answers.
Actually, I would say, and that's, I feel like I have to promote this because not many people have seen it. The full scoring document is online. You can literally calculate on paper, point by point, every single answer option, what that gives you.
So awareness of the openness of the methodology.
Yes. I know the lack of transparency in the scoring model was a past concern to people, but that's all gone.
Now, as an investor, you're enabled to give your own weightings to topics that you think are more important than others. Yeah. So yes, you can make your own assessment and your own score. For instance, me personally, if you look at the scorings nowadays, over 80% is in previous days a green star.
Yes.
Something like that. So that should also suggest that it's time maybe to be a bit more strict about specific topics, especially if I'm also talking to the companies that are participating. A lot of the companies have pretty good policies already, but now it's time to implement those policies and to formulate concise actions per asset. So yeah, that's in my opinion that's the next step. So that as an investor, it would also enable us to put more weight on those kind of topics.
Other existing questions?
Maybe a comment from an investor's point of view, Dirk Welling from APG. With regard to the variable weightings, I doubt a little bit whether that will have an effect. Because when you look at the GRESB universe, and that's what we have done really in depth across our global portfolio, you see that many, or most of the funds, are really lagging in the areas where the highest rating is. So in performance indicators and in building certification. So I really doubt whether the rating will have an impact. Many companies have outperformed in management policies and all these kind of things, which is really paperwork. But the asset performance in that area, there still we see a lot of improvement potential. And I think the way going forward for GRESB should be make a split between manager performance versus a asset performance. Roxana starts laughing. She knows.
We talk often, so yeah. No, it's actually in line with
between the asset performance and the manager performance, and I think that GRESB could rely more on certified data. So when all companies here in the room would certify with one rating scheme, for example, BREEAM in use, there's an API established between BRE and GRESB. GRESB can rely on certified data, and you don't need to ask all the additional questions on the assets. So that will lower the reporting burden, and you can rely on certified data, so the data quality will also improve. I'm just talking about experience for 10 years on the other side of the table, so I'm very familiar with the reporting burden, so I resonate with that. And there's a lot of potential in GRESB, I think. And GRESB is, I think, for us, an ideal platform to unlock asset level data. Because especially for climate risk, it will become much more important to have asset level data.
That could be a nice Pandora's box, asset level focus.
Yes, Matthew, I would like to get back to your question about how we, as listed companies, react to investors' questions about the ratings. My name is Sylvie, and I work for Aroundtown. I'm head of sustainability for Aroundtown SA. So basically, we have realized that not all rating assessments actually fit to our business model. So we focus on 2-3 different ones, and we work very actively with them. We actually encourage them also to come and see our company and our assets so they understand our business model. And when we get inquiries from investors who say they want to see the report from XYZ and we don't work with them, then we simply explain this to them, and then they are quite happy with that. So actually don't have any problems with this system. Because in general, if you would feed all assessments, then you would probably have to employ 1-2 people just to enter the data, and then from an economical point of view, that doesn't make a lot of sense.
That links perhaps somewhat, there's ratings, but people continue to do their own sustainability reporting, their own sustainability sections in annual reports. To what extent do you as an investor, to what extent do you as companies feel that you need things to complement the ratings? The ratings are good, can be improved. You found investors who are willing to accept your argument that some of the ratings will be blind to the qualities and the approach that you have. What role does sustainability reporting continue to have relative to ratings? Just one or just the other, or both still needed? Question without an answer.
Well, I can maybe answer some or address part of it. I think for sure, and certainly you need to add and complement the reporting through whatever system it is with your own internal reporting, external reporting, because you're addressing different stakeholders and different stakeholder groups. You report in a certain way in some things to your investor community, which GRESB does, and through MSCI does to a certain right as well. You report different things or in a different way to the external community, to the unsophisticated user that doesn't understand all the terminology, the very specific terminology, to your employees that, quite frankly, I don't know if they care about the carbon emissions in whatever assets in whatever country. They care more about what you're going to do to improve the health and well-being in the offices, and the diversity program, and the education program, which I think all of these things are very relevant and material from the perspective of a holistic ESG rating measurement, but not that granularly. So I don't think that any rating agency out there or any assessment or any tool like that can cover absolutely everything in the spectrum of ESG. And so obviously you'll have to complement it with something else.
Yeah, and I do think that it's, sustainability reporting in terms of, smaller sections in the annual report or a standalone report by itself, information on the website. It's a really good tool for communicating with investors as to how, integral is sustainability to mainstream business, whether that is embedded or not. And then, even about risk mitigation, what are companies proactively doing? And I think that's also a way that you keep yourself as a leader in your peer space, improving attractiveness to potential investors. So it doesn't mean that ratings are going to take away or substitute for reporting. I think it kind of goes hand in hand. But again, it needs to be strategic. It needs to be very focused and streamlined in that sense.
Yeah, I believe it should be done both. So both participating at the benchmark. That way, it's as comparable as it can possibly be, because there are a lot of differences between the sectors, between the countries and the regulations. So, but that's one thing. I think it's important to participate so that you are comparable with your peers. But I also think it's important to keep reporting on a more detailed level about what I said earlier. So you have ambitions as a company, but how are you actually going to achieve those ambitions and those targets? A lot of companies have separate sustainability reports. Me personally, I think it should not be a separate report. I think it should be standard within the quarterly reporting and within the annual reporting. And then not necessarily as a separate section, because in my view it's part of the integral asset management, portfolio management, and your property management. But that's more on the technical side. That's the way I look at it. Yeah.
So option 1 is we call it a day there. Option 2, a burning question. We've got like 1 minute left. Option 1 it is. Thank you.
Thank you.
All right.